Chairman, very important hearing about the proper functioning of the Treasury market with the growing debt load that we are foisting upon future generations of Americans. National debt is now, what, 38 trillion and growing. I think, Ms. McLaughlin, you said it best in your testimony when you said the greatest risk to the resilience of the Treasury market is the level of the national debt itself. So job number one is Congress needs to get our fiscal house in order, but in the meantime, we should continue to explore all avenues to support the market's capacity to intermediate Treasury debt. Ms. McLaughlin, without primary dealers that can absorb rising issuance of Treasury securities, and without more primary dealers' participation, what happens to Treasury markets?
So I would just note first that primary dealers are important intermediaries, but they're not the only ones. There's a wide range. I think FIC alone has over 250 firms that are two-way intermediaries and benefit from netting in repo and or cash transactions. So primary dealers aren't the entire story, but they're an important part of it. I think if we had a case where Treasury dealers were really, primary dealers were really unable or unwilling to take down further debt, that would be a problem I would hope not to see. I just want to make sure I'm answering your question. Can you repeat the last part?
I think you are. Let me go to Mr. Tabaki because I am interested in you finishing the analysis of what happened in September 2019. I know we have limited time, but finish your thought there. What happened there, and why do you come up with this $50 trillion figure as the breaking point?
The reason why is because most of the regulations to date have been centered around the largest banking institutions, the SIFIs. Now, the global SIFIs, for example, on that date, we had 5 Treasury issues settling. It was quarter end, they're doing window dressing, and at the same time, bombs were being dropped in the Middle East. So what did that do? That caused all of the oil companies to draw down their lines of credit, thinking they'd have to be repairing their refineries. So billions of dollars of cash left the biggest banks. They're already constrained on their balance sheet, and now there's not enough money in the repo market. Those are the type of things that we are most susceptible to if we rely only, and the regulatory environment relies only on the biggest banks.
Well, what happens, same question to you, what would happen to the Treasury market if you've reached the limit of capacity? What happens?
Well, I personally think that we're pushing that envelope today because, again, the capacity issue is not on the buying and selling of treasuries. The capacity issue is on the financing of Treasury because that's what takes up balance sheet. Most of the big hedge funds and asset managers come into the Treasury direct. No longer, the primary dealer desk I ran at Citibank, you would never need the amount of inventory that we had today. But you do need financing capacity. That's the constraint. And that's where we don't have enough participants in the marketplace, and those that are in the marketplace don't have access to facilities like the standing repo agreement.
So more regional banks, that's one solution.
More regional banks, more regional dealers.
More hedge funds.
Well, hedge funds, that comes with a little bit of a grain of salt. Hedge funds, the largest banks now give out repo at 0 haircut. Now, I'm a proponent of hedge funds. I just said it. I'd rather have Americans buying American capital, American pools of capital buying American treasuries. However, nothing is unlimited without any haircut. And just so that you know, a haircut is like the down payment you do on your mortgage. It's an over-collateralization. It is a first loss protection. So without haircut, you allow hedge funds to be basically unlimited in terms of how much leverage they can have.
Okay, I'm running out of time. The SLR fix is a no-brainer, in my opinion, but let me go to Dr. Hsu. Very interested in your more active issuance of floating rate debt idea. Can you elaborate?
Yeah, of course. Currently, the Treasury Department mostly issue coupon securities with a fixed coupon payment. And when interest rates start to rise, these instruments will lose value very quickly. We saw that in Silicon Valley Bank and in many other situations. So if the floating rate debt, the interest payment goes up as the market level interest rate goes up, Therefore, these instruments tend to be very insensitive to the level of interest rate. So people who want to invest their dollar asset for preserving the value would find these instruments to be very valuable.
So lower interest rate risk means more,
Lower risk premium.
more capacity,
Correct, yeah. Correct, exactly.
more purchases of Treasury debt.
Exactly. There will be less penalized on the Barr, for example, valued risk models. There will be less penalized by the capital rules and so on. Yes.
Gentleman's time.